Are the members of the Federal Reserve getting worried about the real estate housing market? Thanks for tuning in. My name is Joshua. I'm a local realtor here in the Roseville and surrounding areas, and I have an article from the Dallas Federal Reserve, and they go on to say in this article, they basically have three key points. The first one is what creates a housing bubble and what it will take for it to pop. The second is what they are monitoring as far as fundamentals and what they call this exuberance factor. It's just like this fear of missing out. And then the third point, the last point, is a summary of what they're seeing and if we are in a potential housing bubble. In the very first paragraph, they say that we argue that the underlying causes of this run-up differ from those of the last housing boom, which preceded the 2007-2009 global financial crisis. Now, they have a chart which we'll get to here in a moment, but one thing I want to make clear is that whenever we come across another crisis, any kind of financial crisis or a bubble popping, it's never really, about 90% of the time, 80% to 90% of the time, it's never the same underlying cause. It's always something new that we didn't know. They go on to basically say what they're monitoring in regards to the real estate market. And a couple of things that they are monitoring is the disposable income that people are getting, the cost of credit and access to it, which is basically interest rates and loans, the supply disruptions, the rising labor and raw construction material costs are among the economic reasons for sustained real house price gains. Now, this is what they are putting into their formula to see this price appreciation be legitimate. Now, a couple of areas that I think are going to shift here in the near future is obviously the supply disruptions, which they pointed out, and the material costs, because those two are so interlinked together. Whenever we can't get enough material or supply to these job sites or just to anywhere, right, the prices just automatically rise. So we will see at some point in the future a shift of those two. But that's what the Federal Reserve is basically putting on into their fundamental aspects of the real estate housing price appreciation. When there is widespread belief that today's robust prices will continue. Now, if many buyers share this belief, purchases arising from the fear of missing out, or what they call FOMO, can drive up prices and heighten expectations from a strong housing market. Now, basically what they're saying is whenever investors continue to gobble up all these homes, the average people, you and I, begin to start to create this fear of missing out and this expectation of home prices to continue to skyrocket into the future and basically forever, which we all know that's never the case. So the Fed also goes on to point out here that the self-fulfilling mechanism, which is the fear of missing out, leads to price growth that may become exponential or explosive, resulting in the housing market to become progressively misaligned from the fundamentals until investors, keyword is investors, become cautious, policymakers intervene, which is always after a market kind of takes a correction or starts to melt down. And then the flow of money into housing drives up, which is obvious. If you over leverage, you're not going to have much more money left over in the housing market. And the housing correction or even a bust occurs. So they're basically laying out what will happen when investors, the big players that buy bulk properties in 100 to 1,000 properties per month, whenever they start to unload, that is going to start to make that market shift. So whenever we follow, so it's something that I like to do is just follow the flow. When investors stop buying, that's the time to plan and get ready to sell. And whenever they start selling, it's hard to catch a falling knife. Techniques that are significant in the periods are date stamps to signify the exuberance or the price growing at an exponential rate exceeding what economic fundamentals would justify. Now, in this graph, you can see here that anything that jumps over that 95% confidence level is in this exuberance phase. And you can see back to the run-up of, or the housing market to the run-up of the Great Crisis, we were just rocketing above that threshold for an extended period of time. Now you can see where we are now. We're starting to have a little bit dip down, but if this thing continues to rise, you can see that this is one of the areas that the Federal Reserve is watching to see if we're in a housing bubble. Now, the Federal Reserve is also taking a diagnostic approach to the housing market. And what they're basically doing is working from a benchmark of the house price rent ratio, which is explained in their statistics as a small set of lagged economic variables such as personal disposable income per capita, housing rents, and long-term interest rates. And you can see here in this graph that on the top part we have price to rent ratio, and whenever that starts to come extremely high off of the fundamental price to rent ratio, we start to see a bubble form, and this is what the Federal Reserve is watching. And now if you look into present day, we are seeing that skyrocket, right? We're seeing it skyrocket pretty quick, almost as quick, or if not maybe quicker than the past housing bubble that we saw. And they also have down here the exuberance factor. You see we're not too high off of the exuberance factor, but we're starting to see it go into the levels of either it's going to start to flatten out and come down, or potentially even go higher. So this is one of the things, or one of the criterias the Federal Reserve is monitoring for this housing boom. Now they also have a chart here that goes for the price to income ratio, and we could see that our income ratio has not hit that exuberance level of the threshold just quite yet. We've seen the uptick, but if you look back on this chart and try to measure it out, we're still pretty far below of an income level that we saw prior to the last housing melt up. Now the Fed goes on to just highlight what they're saying, and their evidence points to an abnormal housing market, which is for the first time since the boom of the early 2000s. Now, reasons for their concern are clear in certain economic indicators, including the price to rent ratio. It's unsustainable in their eyes as well as my eyes, especially with the lag of income growth. The price to income ratio, which obviously prices are just they're elevated quite high, as I'm sure everybody knows, which shows signs that the 2021 house prices appear increasingly out of step with fundamentals. Now, the Federal Reserve isn't fully worried, and they go on to say in this article as well that it's not the same as what we saw as far as the last housing crisis with everybody being able to qualify for mortgages. Basically is the wild, wild west as far as qualifications and mortgages. So a lot of people that didn't qualify for homes today or were able to qualify for homes last time, and then whenever everything shifted, obviously a lot of people lost their homes. So they go on to say that it's not the same as last time, but as I said in the beginning, there's always a new needle that pops the bubble that we didn't plan for and we didn't expect. So if you guys found this interesting, please like and subscribe so I know to make content just like this in the future. And I will have this article in the show notes below. Talk to you guys soon.